Good evening, everyone. Welcome to the Power of Passive Investing Meetup. We are happy to see all of you today, and we are thrilled to announce that we have none other than Jack Cohen with us. Jack is a CPA at Campbell Johnson Cohen firm. He has over 30 years of experience with IRS, which I hope he'll tell us more about and maybe share some fun stories. He has worked in large and mid-sized CPA firms. He was also given David Bernard Award in 2006, which is emblematic of Employee of the Year nationwide within the division award. Jack is licensed in Nevada, Pennsylvania, and New Jersey. He is also a licensed real estate broker in Nevada and Pennsylvania. And we typically ask people to have a presentation, but I figured that many people have questions that are related to real estate, and it would be much better to have interactive session and allow everyone to chip in and ask questions. So we will be switching to that shortly. The usual disclaimer, so this is not an advice, this is for educational purposes only. So please take it to your own CPA and consult with your own CPA. Housekeeping, so this does not apply today. Again, feel free to hop and unmute yourself, ask question. If you prefer to type it in, feel free to type it in and I'll ask for you. That's fine as well. Our next event is on April 1st with Troy Eckert. He's going to talk about mineral rights as investment, and I recently learned that this is also considered a real estate investment. And also, folks, another announcement, sometime, I think end of April, you'll see the date. We are switching to Wednesdays, so while this event is still on Thursday, I think the event after that, or maybe two events after, we're going to be switching to Wednesday. It's still going to be at 7 p.m. Eastern, but it's going to be now every other Wednesday after that. Future events. So after that, we have Dmitry Fomichenko coming over and talking about checkbook IRA and solo 401k. And after that, we have a networking event. So it's going to be pure, full hour of pure networking. Everyone's going to be put in the groups and we'll be going from one group to another. This is my contact information in case you still don't know how to reach me. This is my name, website, and various social media handles where I can be found. So that's it for me. I would like to pass the stage over to Jack. Jack, why don't you start over by giving us a little bit more of your bio and sharing some more information about where you come from? And
sure. Well, if you want to go back, I'm originally from South Philly, and went to work for the IRS as soon as I graduated college. Turns out I wasn't very book smart, but I was street smart, and I was a pretty famous revenue agent. And they would give me all the high-profile audits. Muhammad Ali was one of my audits. I put the oldest Chevrolet dealer in Philadelphia out of business. I mean, I was really good as an agent, and got into management early on. So I was a manager there for more than half my career, and did tons of different things when I worked for the IRS. I taught all the time and traveled, and I ended up in large corporate audit. And some of my audits, any Fortune 500 company that was in the Philadelphia area, I probably managed the audit of. Bell Atlantic before they became Verizon, Campbell's Soup, Cigna Insurance, and I was pretty famous there. And decided to retire early and moved to Las Vegas. Ended up working for somebody, opening up my own CPA firm, and turns out I was just as good in public accounting as I was in working for the IRS. And in not that many years, we're probably one of the biggest local firms here in Las Vegas now. I think last week we hired 4 more people. We have so many people, I don't even know who these people are. We have to get like name tags for these people. I mean, and so our firm basically does, when I say full service, we actually do real certified audits, which is something that most CPA firms don't do. We have one partner that specializes in estates and trust. One partner is the audit manager. One partner specializes in nonprofits. Myself and another partner, we specialize in tax. So we do a lot of corporate structurings. I think it was Rick who asked if we're a commercial registered agent. So we do a lot of corporate structuring. We'll set up your entities. We, because of my IRS background, we do a lot of representation work. I mean, I probably have more audits than most revenue agents have. And so we represent people that are in trouble with the IRS, either audits or collection. And since the pandemic, I mean, we've gotten even busier. One of the big things we work on now is we work on the PPP loans. And I mean, we've gotten millions and millions for our clients already. I mean, this is incredible. These are strange economic times, and certainly strange for taxes and CPA firms. As many of you know, they changed the tax laws in 2018. And so I think that because we're a reasonably larger size firm, I like to think we keep up on things. And so as laws are changing, the PPP laws change every other week. That's all I can tell you. It's unbelievable. If you've ever wanted free money, this is the time. That's all I can tell you. I mean, and what's amazing is how I have to talk people into taking free money. You would think that you wouldn't have to convince them. And when I tell them it's free money, it's like, well, there must be a catch. And I say, no, it really is free money. You just have to listen to me. And so we have tons of real estate investors as clients. I personally, when I lived in Philly, owned tons of real estate. Now, I was a little unusual because I could actually rehab the properties myself. Growing up in South Philly, all my friends were in the trades. They taught me how to do everything. So I would buy properties that were not fit for human habitation. I'd rehab them and flip them long before they were on TV, okay? And so over the years, I've owned tons of real estate, and now as a CPA, we have tons of clients. And my clients are all over the United States and in most foreign countries, believe it or not. We have tons of clients that are not U.S. citizens that have companies here. They own real estate here. And so we really are the place to go to if you have a real estate question or problem or a tax problem. I apologize for talking fast, too.
Jack, you're absolutely good. I think it's great. So again, folks, this will be the meetup and the place to ask real estate questions, any questions that you have. Definitely feel free to unmute yourself. I want to open up, Jack, and start maybe, can you spend a few minutes on the potential tax implications that the current administration is planning to implement? What do you think about them?
Sure.
What do you think is going to be implemented?
I mean, I can tell you what I've read about.
Yeah.
And I know that Biden wants to change some of the rules for people who make over a certain amount of money. Now, this is kind of a funny story, but if you remember when Obama was running the first time, and somehow in his mind he developed a cutoff of $250,000. So my theory is if I'm making less than $250,000, I'm for Obama. If I'm making more than $250,000, the hell with these poor people. I'm voting Republican. Well, now Biden, I think somehow from what I read, Biden's cutoff is around 400,000. So there's a lot of things in the tax law that have some tax advantages like capital gains, preferential dividends. So what I've read is if you make over a certain amount of money, I think he wants to take away some of these tax preferences. And so, which is unfortunate because real estate, I mean, carries with it huge tax advantages. I mean, where else can you get ordinary deductions for depreciation and you get capital gains when you sell it? So the thing to keep in mind too, and I tell people this all the time, the reason the tax laws are the way the tax laws are not necessarily for what you think it is. They use the tax laws to try and affect economic policies. That's why they have child care credits and earned income credits. I remember they would have laws on the books that were identified for specific companies. A great example, one of my audits was Bethlehem Steel. They had a law on the books just to help out Bethlehem Steel. And so many times when they pass these laws, it's not just to generate revenue. A lot of times it's to do other things. And so that's something to keep in mind. But But certainly, if they were to change some of these rules having to do with capital gains, I would think that would not be very helpful to the real estate market. I don't know that it would kill the market, but I don't think it would be helpful. And again, you go from administration to administration, it's always changing. That's the thing. I mean, so the thing is to try and keep as up to date as you can, and try and strategize as much as you can based on not only the current laws, but certainly what you think could happen. The other rule of thumb I have too, and I think this applies to real estate transactions as well as any transactions, you never do any kind of a deal based solely on the tax attributes. I've seen huge companies make big mistakes. At the end of the day, if you decide you want to do something in business, or you decide you want to buy real estate, the decision should be based on the merits of the transaction itself. Don't buy it with the idea in mind that you're going to save taxes. Saving taxes is kind of like whipped cream on top of the sundae, okay? If you're so focused on the real estate tax, or the income tax part of this, you can end up making a bad investment. I mean, I've seen it happen. I mean, people are just so focused on saving taxes, they forget about the deal itself. So keep that in mind. I'm trying to think. So outside of I remember they talked about dividends maybe being changed, and capital gains. I don't know. I know they talk about putting an additional tax on the super rich. What was it? I forget which senator it was. If you make more than $50 million, they were going to hit you with an extra 2%. Even today, by the way, this changed years ago. If you make over a certain amount of money, they have that 3.8% surtax on passive income. And by the way, CPAs mess that up all the time. They get it wrong. But if your income is over about a certain amount of money and you have passive income, not only do you have to pay income tax on your taxable income, they hit you for another 3.8%. There is a lot of strategy that goes in to preparing your tax returns and how you treat things. And so I can't think of anything else that Biden talked about. I think those were the three big things. And of course, today, the big things are the PPP loans. The other big thing, which we see other CPAs mess up all the time, is the Section 199A deduction. I don't know if the listeners are familiar with that, but that was another part of the 2018 tax law, where it said basically if you're in business, instead of having to pay tax on 100% of your income, you only have to pay tax on 80%. But a lot of people don't realize that applies to real estate as well. And we see
what is the definition of the business, Jack? So from that point.
Well, real estate has its own rules. And generally, real estate, the default is real estate generally starts off as a passive activity. And so for loss purposes, that's always an issue for investors, because if you have over a certain amount of income and you have passive losses, you can't claim them on the return. They're deferred. You can't claim them currently. However, if you meet the definition of a full-time real estate professional, then you can claim the losses. And that definition is based on you have to put 750 hours a year on real estate.
And I'm sorry, I'm interrupting. The same concept applies to Section 199?
It does not. That is the amazing part. Oh. So first off, keep in mind that most real estate, when you think about it, even if you have a positive cash flow, most real estate generates tax losses. That's the way it's supposed to work. So 199A is not going to help you if you have a loss. But what if you have a gain? And many times we'll see investors, maybe, for example, they've owned the property for a while, and maybe they don't have a mortgage. They don't have mortgage interest. Or maybe it's a self-rental. Say it's a doctor, and he has a separate LLC that owns the building, and it rents into his practice. So many times we'll see rentals with positive income. Here's the rule on 199. This is an absolute gimme. The rule on 199 is you have to put in 250 hours. However, it doesn't have to be your 250 hours. It could be anyone that works on the property. So it's the people you hire. It's the management company. So the truth is, just about anybody can make the 250 hours. And if you do, and you have positive income, somebody asked if my sister's name is Joanne. No. if you, if you have positive rental income, that actually qualifies for the 199A deduction. And I've actually seen CPAs miss this.
Wow. And 199A, what form does it apply to you as an individual or your corporation?
It actually applies to you as an individual, but it's calculated based on the income that you derive either from, say, a subchapter S corporation or a partnership, or even if you're a sole proprietor. I've seen people miss that. Say you're a Schedule C sole proprietor. Your income from that is also subject to 199A. It's a great deduction, by the way.
Excellent, Jack. So for the folks on the phone, where should they look for it? Is it itemized deduction?
There's actually a line item on their 1040 that has, it's called qualified business income.
So it's on 1040 itself. It's not on any.
It's right on, I think for 2020, I believe it's on the first page.
Okay. Yeah. Line number 37, 56.
Come
on, you have to.
You're testing me on this one. That I can't tell you. Yes, I'd be making that one up.
I'm completely making the question up.
Okay.
Next question. No, this is an excellent feedback for everyone. Question from Ken. Should I open 5 different bank accounts for 5 different properties, LLCs? So
great question. So first of all, if you have separate LLCs, LLCs are legal entities. And the truth is, if you have separate LLCs, each LLC should have its own bank account. Remember, one of the reasons you do LLCs is because you want to provide yourself liability protection. So you really don't want to smush stuff together because you don't want to get sued and have someone pierce the corporate veil and say, wait a second, you're really not a separate LLC company. You're really operating as an individual person, and they want to try and pierce that corporate veil. So the truth is you definitely want to have separate LLCs. Something that people will use, it's not legal in all states, and I know you know about this, Alina, it's called a series LLC. And that's a weaselly way around having to set up separate LLCs for many properties. It's a little tricky. It's not legal in every state. And so what happens is the way series LLCs work, you have this one parent LLC. Underneath it are individual cells, which represent individual properties. So each individual property has to get its own EI number and its own bank account, and you have to keep separate records, but you only need to create one LLC that covers all of them. The tricky part is, number one, I said they're not legal in all states, but the other tricky part is if you want to maintain the liability protection, you have to have really good record keeping. I mean, it has to be perfect. You can't commingle stuff from each LLC, but that's one way around setting up separate LLCs for all the companies. Another possibility would be too, there's nothing necessarily wrong with having one LLC own more than one company. What you have to be careful on is you don't want to have too much equity in any one LLC. So let me give you an example. Say you had 5 rental properties and you had mortgages on all of them, okay? The truth is you don't have that much equity in them. Nothing wrong with putting them all in one LLC, because if somebody sues you, you don't have that much equity to lose. The problem would be, say you have 5 properties and you don't have any mortgages, so now you have tons of equity. Then you don't really want to put them all in one LLC, because if the LLC gets sued, theoretically you can lose them all. Excellent point. Thank you, Jack. Next question is about opportunity zones. Mike is asking, if we incur capital gains in 2020, how long do we have to reinvest in opportunity zones? This is going to be one of those questions where I'm going to take a pass. One of my employees is an expert in this area. And there's, it's funny when you read things like about opportunity zones, or I can give you tons of other examples where they have these different tax strategies. They all sound very simple, but trust me, they ain't that simple. So on opportunity zones, there's a whole bunch of rules that go along with it, having to do with putting so much money in, the holding period. Anybody who has a question on opportunity zones, if you could just send me an email, I'd be more than happy to put you in touch with one of my guys. He's a whiz on this. He'll help you. So.
Awesome. And guys, I'm just going to take a minute, say we want to encourage interaction between the group members as well. So Raphael and I have put together a spreadsheet, which I posted. And feel free to put your information if you want to network with others. Whoever put the information in, we'll share it. We'll share the full spreadsheet with everybody once that information is there. And we'll continue doing that in our future meetups as well. Moving on, next question is, what are your thoughts on law changes to Section 1014, step-up basis? And Jack, maybe give a little preamble what step-up basis means so that others understand.
Capital basis in property or in an entity?
Section 1014.
Tell me what tell me what it's about.
You want to clarify?
Like, I guess property, inherited property.
Oh, inherited. Now I'm talking. So, okay. So again, here's where some strategy comes in, and we do a lot with people who have revocable living trusts. So what happens is that when you pass away, okay, and you own property, or you have a revocable living trust, okay, what happens is that gets revalued when you die. And it gets revalued up to the fair market value on the day you die. So then when you pass along the property to the beneficiaries, effectively, they get a stepped up basis for tax purposes, which works out great. So say you bought a property for $100,000, now it's worth $1 million. You pass away, you leave it to your kids. Their tax basis is $1 million. Literally, if they sold it the next day, they would have no income tax liability on it. Now, what's interesting, there's been a recent change in the law in California, by the way, which kind of ties into that. I'm assuming nobody's from California. California has the wackiest rules, I can tell you that. And so California had issues where they had passed a law that says if you live in your house, they won't raise your real estate taxes. They won't reassess it based on fair market value, because you can imagine property values in California are like really high. So if you live there a long time, then your property taxes will be low. And going back to what I said, if you died and you left the property to your children in California, they would get a stepped up tax basis, but they also would not raise your real estate taxes. Well, guess what? California just changed that. So people are like flipping out. So if you leave the property to your kids, instead of paying the low amount of real estate taxes, now they reassess it to fair market value. Effectively, the children would probably have to sell the house. So did I answer your question about the stepped up basis though with death?
Yeah, I guess, do you think it's going to change on a federal standing or? Well,
they talk about changing the inheritance tax laws on the federal basis. Now, I think it had been up to about $11 million a piece. Now, here's an interesting factoid about how some things are more myth than reality. The reality is the government actually collects very little in federal inheritance taxes. Did you know that? It's a joke what they collect. And the reason is most rich people go to really, really good lawyers and they never pay it. But it's kind of like a wedge issue with people, because they think that rich people should have to pay inheritance taxes on all their properties. So the truth is, whether it's 11 million or they drop it to 5 million, rich people still ain't going to pay. Now the bigger issue, in my opinion, more so than federal inheritance taxes, is state inheritance taxes. And that is a real issue. I come from Pennsylvania, where there's a state inheritance tax. Well, the truth is, if you owned a lot of assets, you'd be much better dying in Nevada than you would in Pennsylvania. Because in Pennsylvania, your beneficiaries are going to pay a lot in state inheritance taxes. There is no state inheritance tax in Nevada. And I think there may be a state inheritance tax in New Jersey too. I can't recall. So what I tell everybody, if you've accumulated a lot of assets, it's probably not a bad idea to basically set up a revocable living trust for yourself and think about doing some planning in advance of your demise as to what you think you want to be done with your assets when you die, so that your beneficiaries don't get hung up having to pay a lot of taxes. A lot of strategy here.
No,
First
Jack,
thing is don't die, by the way. That's a really good idea.
Can I ask two small quick follow-ups to that?
Sure.
go for it.
For this on the step up thing, is it still effective if the property is in an LLC? And my second question is, along with getting rid of the capital gains, does it also null the depreciation recapture?
I haven't heard anything about depreciation recapture. I don't think that's going to ever change. I think they only talked about changing the capital gain rules. Okay. If you own property in an LLC, but here's the thing you're forgetting. What is an LLC worth? If you own the LLC, it's worth based on what the property in the LLC is worth. So either way, whether you left people the property or the LLC, they're still going to get a stepped up basis. So you'll be fine. Just remember, don't die. There's just no future in it. That's all I can tell you.
Jack, back to your question on setting up, I think you said the revocable trust.
Revocable living trust, correct.
Revocable trust, okay.
There's revocable and then there's irrevocable.
And you recommend setting up?
Well, most people do revocable. Revocable means what it says. Basically, if I have my children as the beneficiaries and I get pissed off at them, I can write them out of the trust. So revocable means you can change anything in it. Technically, irrevocable ones, once you name the beneficiaries, it's kind of hard to get them out of it. Okay, so most people use a revocable living trust. And the other thing about revocable living trusts is the fact that for tax purposes, it's pretty much ignored. So let's just say I have a revocable living trust that owns real estate. I have rental property, and it has rental income. What happens is the activity from the rental doesn't go on the beneficiary's returns. It goes on my return as the grantor of the trust. So the beneficiaries are not affected by this at all. So for tax purposes, it's totally it's invisible. And the other thing I think I should mention, some people think that by using a trust to hold property, that helps you for liability purposes. It does not. Trusts provide no liability protection. What most people will do, they'll set up an LLC, have the real estate in the LLC. The LLC provides the liability protection, but the trust will own the LLC. So you get the liability protection, but for estate tax planning purposes, your trust will be the owner of the LLC.
Does LLC have to be in a specific state to provide better or worse protection?
That is a great, great question. I'll pay you later for this, okay?
Thank you. I know the answer, but I want you to share with others.
So LLCs, you're like a shill here. You know what I'm saying? You should have fed me like a really, really tough question ahead of time. And then when I know it, everybody's going to think how smart I am, not knowing that you already gave me the question. So what happens is, and we just had this with a client a couple weeks ago. LLCs, companies, corporations are legal under state law. So for example, if you set up an LLC in Nevada, it's legal in Nevada. If you're doing business in another state or you have property in another state, it's not legal in the other state. You have no liability protection at all. Now, you don't actually have to set up a separate LLC in the other state. What you can do is you can register your existing LLC in the other state. And the legal term is called foreign filing, which is just a fancy word for you got to register it in another state. So, for example, we had a client who thought he was smart, ha, 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 and he wanted to save a couple of bucks, ha, ha, ha. And he sets up this company in Wyoming. People like Wyoming. Why? Because it's cheap to set up a company in Wyoming. However, the property was in New York. It was a waste of his money. It was no good. And a lawyer set it up for him. And I told him, it's no good. And he goes back to the lawyer. And the lawyer begrudgingly admitted that I was correct. And this guy was really pissed off because he listened to the lawyer. So LLCs are legal under state law. So if you have real estate, I don't care where you live, but if the real estate is located in another state, your LLC has to be legal in that state. And it's easy to do. It's not a big deal. So, I mean.
Excellent answer. Jack, next question, I think it's from Dwayne, but let's see. So what is the suitable structure for short-term rental business in Connecticut? I was told LLC and elect a C Corp or S Corp. I forget which one, but this is so that like the best way to do it.
So first off, Jack's first rule is C corporation should never own real estate. It's a really, really bad idea. And here's why. C corporations don't get the benefit of capital gains. That's number one. So if your C corporation sells a property at a huge gain, it has to pay regular corporate tax rates. Reason number two, okay, C corporations, in order to get the money out of the C corporation, you have to pay tax again. There's this concept of double tax. So it sounds like a great idea. Right now, the corporate rate for C corporations is 21%. But if you take it out as a dividend, you're going to pay probably another 15%. There's just no advantage. Reason number three, C corporations, if it has a loss, which generally real estate does, losses are stuck in the corporation. You can carry them forward and use them in future years against future gains, but that's the best you can do. If you owned real estate that had a loss, either on an S corporation or a partnership, or even if you owned it individually, there's a chance that you could use some of the losses to offset some of your income. So first off, C corporations should never own property. Airbnbs are a lot different in a way, because, and I've had a number of IRS audits having to do with Airbnbs. Airbnbs are not like typical rental property. The best way to describe an Airbnb, it's like being in the hotel business, all right? If you have long-term rentals, you are stuck with the passive loss rules, but Airbnbs are not like that at all. And so in theory, one possibility is you could probably report Airbnb income literally on a Schedule C if you wanted to. Now, I don't like that either, because then you can end up having to pay self-employment tax. But certainly, real estate, normally we would put it in either a partnership return or a sub S. Buys and holds, meaning properties that you buy and hold for rent, partnerships are fine on. Buys and flips, if you're buying and flipping, sub S is the way to go. That's it.
Guys, does that answer your question? Or do you want to get clarification?
Jack, when you say buy and flip, what time frame are you talking about? A 5-year flip or a 5 month?
No, flipping right away. No. If you buy and hold for 5 years, you're fine. That's a buy and hold. But there's a lot of people these days that'll buy properties just to rehab them and then turn them over right away. So yeah. By the way, I used to do that. I buy them and try and flip them. I remember I went to closing at 10 o'clock to buy it and 11 o'clock to sell it. That was the easiest money I ever made.
Next question, Jack, from Leon. Do you like to use series LLC for several different properties? For example, if you have 5 different houses.
I am not a big fan, even though it saves you money because you don't have to set up 5 LLCs. I'm not a really big fan. And again, they have to be in the right state to begin with. And the other problem is people traditionally don't do a good job with their record keeping. I already know ahead of time. When you bring your stuff into me to do your tax return and you hand it to me in a shopping bag, I pretty much know your record keeping sucks. Okay, probably not a good candidate for a series LLC. That's all I can tell you. So, but here's the thing: each situation is totally different. I mean, and that's why people come to me and they say, Jack, what should I do? I take a look at their tax returns. I take a look at what their strategy is, and I tell them what I think they should do. And if I thought a series LLC would be appropriate, I would recommend it, of course.
Awesome. Next question from Isaac. Can you help me understand suspended passive losses better? Do they all get pulled together, or am I technically using them in order they're received? I'm a regular W-2 employee who is capturing a ton of suspended passive losses from accelerated depreciation and syndication deals. Aside from using them to offset distributions, depreciation, recapture, and capital gains, any other ways I should be optimizing them?
Sure. And you know, that's a great question. And here's the thing when it comes to passive loss carryovers, because it sounds like this is what this person has.
Yep.
Sometimes this is a great example. This is a true example. So we had a client come to us who they had some money. I mean, they were high income, and they had all these passive loss carry forwards, and they had a property that they weren't doing well with. In fact, it had a negative cash flow, but they were upside down in it. And I proved to them on paper they would make way more money if they sold the property and had to bring money to the settlement table. What they would, by releasing all those passive losses, they would gain way more in taxes. They would eliminate the negative cash flow. Maybe they had to come to the table. Maybe they were upside down by 20 grand. I figured out they would probably profit by $80,000 by selling the thing. Okay, so what you have to really do is, if you're an investor and you have all these properties, you have to kind of keep your eye on the road and kind of analyze every property to see, you know, is this worth still keeping? I mean, and so, but I think the other part of the question is all of these losses get dropped in the buckets. Now, you can make an election to group your rental property losses together, okay? But again, at the end of the day, the best way to use them probably would be either to have large gains or dispose of the property, which I know is counterintuitive to many people, because many people buy investment property to hold for a long time. But remember, this is a business. As my mentor in real estate used to tell me years ago, you're not married to these properties. It's an investment. So you can't fall in love with them, okay? And so sometimes, as Kenny Rogers would say, sometimes you got to know when to hold them and know when to fold them.
Excellent. Next question is from Umar. If we create separate management company, LLC or something else, which takes care of all income expenses, including mortgage taxes, do we still need to file income taxes for other LLCs that hold real estate?
Repeat that question. So they form their own management company?
Correct. But they have properties under either other LLCs or
Sure.
other names. What are they filing taxes for?
They have to account for they have to account. The management company is a separate entity that maybe it makes money doing the management, but the actual activity from the property itself has to be reported someplace. And it's going to be reported to whoever actually owns the real estate, whether it's an LLC or it's owned individually.
Now, Jack, does it matter? It's not in the question, but would it matter if there was parent-child relationship between these companies potentially?
The only issue you have is the IRS has an issue. Anytime you have transactions between related parties and you get audited, there could always be a question as to whether you're trying to kind of finagle where the income is. I mean, and so, for example, I don't know, you might know this answer better than me, but say you have a management company, maybe they charge 6% of gross rentals or 10% of gross rentals. Well, you can't have a management company and pay them 25% of gross rentals. Obviously, that's not an arm's length transaction, so that could always be challenged. And the other issue is too, and I see this a lot, there's a lot of companies out there that make money from setting up entities. I know because I used to work for one, and they were a sales company, okay? And so I've seen many situations where people get talked into setting up all these entities, but at the end of the day, they serve no useful purpose at all, other than making the company that sold them to you rich. There has to be a logical business reason for setting up an entity. It's either got to be a liability or there's got to be some tax benefit that goes along with this. So if you set up a separate entity to manage your real estate, you would have to convince me why you need it. What's the purpose of doing it? Now, if you're managing other people's properties, different story. But to set it up just to manage your property, now, I could probably think of some reasons maybe why, but the odds are probably not.
Excellent answer. Umer, does that answer your question? Anything else? Okay. Next question from Rick. How much is the tax rate?
I'm sorry, can you guys hear me?
Your voice is muffled.
Is it better now?
No, not really. Do you want to call back like on a phone or from your computer?
Or not texted, but but chat. Go in the chat or put.
The maybe put it in the chat because your voice is muffled.
Yeah, that's why I was trying to. But is it better now?
Better now.
We can hear you. Go for it.
Perfect.
Okay. Now my question. The reason I was asking that question was if I own the other. Let's say I'm just managing my own properties with the management company, and management company is also mine. And all the transaction, all the cash flow, the rents received, everything is going through that management company. I won't have to, it's going to save a lot of bookkeeping because you have to manage a lot of other companies.
The problem is when you're a management company, you're collecting the rent for the owner. So for example, the management company is not going to report rental income. It's just not. It's not its income. The only income the management company should have is just how much money it earns from managing the properties. So the truth is all that income actually belongs on another separate return.
Jack, correct me if I'm wrong. Does it sound like Series LLC? If this were Series LLC, that everything passes through to the top LLC, in that case, you can report it under one, but not otherwise.
Right. On a Series LLC, that's different. But this management company is not the same thing.
Right.
Yeah.
Okay, thank you.
But the other thing too, and again, you have to remember this too, and this has to do with bookkeeping and record keeping, whether it's on rental properties or businesses. It's never a bad idea to do a good job on record keeping. And here's why. Forget the IRS for a second. Don't you want to know how you're doing? I mean, that would seem to make sense. I owned a lot of rental properties and I tracked everything by property. And the reason I did it is because I wanted to know, am I making money or am I losing money? I didn't do it for IRS purposes. I did it for my purposes. So, I can't emphasize enough. I mean, I'm not saying your record keeping has to be perfect, but it's really important. I mean, for financial reasons, for investment reasons, you want to know how you're doing. You smush all this stuff together. I mean, how do you know when it comes time to sell a property, maybe you want to sell off one of your properties that's a loser? Well, how are you going to know if you got all the records all combined?
How do you know it's a loser if you don't have clean records?
Yeah,
I totally agree with you. I mean, that makes the profit and loss for each property should be separate. The only reason for that management company was that I thought that it's going to take out the pains of having separate bank accounts and filing separate taxes for each and every LLC.
Here's the thing. Even though I say you have to account for each property separately, unless they're separate LLCs, really, say you had 5 rental properties, there's nothing wrong with having one bank account for all 5 rental properties. And by the way, if you're using QuickBooks, there's a way to actually segregate. There's certain versions of QuickBooks that you could use that'll actually separate the properties for you within QuickBooks. It's a more expensive version.
If you have one bank account for 5 properties, then isn't that commingling? Because I mean, technically, then they can actually pierce the corporate veil if something happens in one.
Well, okay, so if it's an LLC and they're all owned within the same LLC, the bank account don't matter. If it's at the same LLC, yes, if they pierce the
correct, but if they're separate
LLCs, if they're separate LLCs, you really want to report them. Well, first of all, something we didn't talk about is single member LLCs. So, but yes, if you have a separate property in every LLC, you really should have a separate bank account for each one. That is true. In order to maintain the liability protection, that is true. You should. I'm not saying you like the answer or it's not painful, but that is the book answer.
Okay, that's where I thought that, because I mean 4, 5 is fine, but 20, 25, 30, that's where I thought that having a management company might.
But you're saying you have separate LLCs for each one of those 20 properties?
So even we started combining 2 together, but yeah, there are a bunch of LLCs.
Yeah, I'm just saying, but this goes back to my point earlier. With some of these companies, you'll have 20 properties and they'll convince you to buy 20 LLCs. Why do they do that? Because they make more money. That's why they do it. And so again, there's a little bit of strategy that goes on. I mean, again, I don't know that there's a problem having an LLC own more than one. You just don't want to have too much equity in them. That's all. I mean, or perhaps a series LLC would be better.
Yeah, series LLC, I couldn't find. It's not in the statute of New Jersey, and I think even not in New York.
That could be. I said at the beginning, they're not legal in all states. Yeah. There might be some other things we could think about too, by the way. That's why they pay me the big bucks.
Excellent.
You're laughing, Alina.
Next question, Jack.
Okay.
Rick, how much is the tax rate for trust now?
How much is the tax rate on
trust?
Trucks. I don't understand the question. I mean, trucks get a better deduction than cars. I can tell you that.
Trust.
Oh, trust. Trusts are very high, and it's probably like 35%. They're really high. So what happens is you could have, all right, this is more complicated, but you can have an irrevocable trust. Irrevocable. And generally, irrevocable trusts file separate tax returns, Form 1041s, and they can pay tax. However, this will give you a headache, but you can have what's known, they refer to it as an intentionally defective trust. It's an irrevocable trust that's treated like a grantor trust. So instead of paying the tax at the trust level, it gets paid at the beneficiary level. So we had a client, and this trust had all this real estate. Now, when the real estate was losing money, no big deal, because there was no tax at the trust level. Now the trust starts making money. Now the trust is going to have to be paying big tax. So we decided we should treat it as a grantor trust. So instead of paying the tax at the trust level, it flowed through to the beneficiaries, which are the guy's kids, saved them zillions, a lot of tax. So you don't really want to pay tax at the trust level. That's not a great idea. But it can be avoided, is where I'm going with this.
Okay. Next question. What other tax rules should one know as a new investor? And I'm guessing it means real estate investor. And what are the best practices as a business owner to not be a red flag for audit?
All right, let me answer the last part. If you guys, or I don't know if there's any women else on there, but if you're ever bored, every year the Treasury Inspector General issues a report card to IRS, and in that report card, it details what returns they audit, okay, as a percentage. I would say every year for the last 15 or 20 years, it's changed a little bit, but not that much. So the audits, and if you want, I can even go back and tell you how returns get selected for audit. But Subchapter S corporations and Subchapter S's, the audit selection rate is 1/4% of all the returns that are filed. The truth is, if you file a Sub S return, it's highly unlikely you're going to get audited. Partnerships are probably about 1/4%. C corporations, probably about 1/2%. Your individual returns have a much higher chance of getting audited than your corporate returns. Another reason, if you're going to be in business, maybe if you're going to have rental property, filing a separate LLC return is maybe a little bit of an audit protection. Yes, you have to pay to have a separate return filed, but the odds are you're not getting audited. How do returns get selected for audit? Okay. What happens is the IRS does a stat sample. They'll audit a specific number of returns and they'll develop, they do like a statistical analysis from the audit of this sample. From that, they develop a formula. And they basically assign a score to every tax return. So based on the sample that they now apply to the general population of returns, they know, for example, here was a great one, probably doesn't apply anymore. They know, for example, if you claimed a casualty loss on your return, the odds are it was wrong. That adds a lot of points to the score. Or let's just say you had low income and you had like $1 zillion in contributions. Highly unlikely. That might add a high score. You might get a high score from that. So the theory is the returns that have the highest scores have the highest probability of error. That is what the Internal Revenue Service believes. And that is how they pick your return for audit. Now, the truth is, it ain't the truth, but that's what they believe. And that's how they pick them. Would you like to know why I think they're wrong?
Please.
Normally, if I'm a CPA and I'm doing a return and I think it looks funny, I'm preparing for the audit as I'm doing the tax return. I am going to have everything ticked and tied. The truth is, I can make an argument that the returns that look the cleanest are the ones that have the biggest errors. I'm just saying, if I'm a CPA and I know this return looks bad, I'm ready. But they believe that the ones with the highest scores have the highest probability of errors, and that is the system that they've used for years, and it's never changed. Notice I'm drinking Gatorade. Normally, I'm drinking the hard stuff. Wait, hold on. The industrial size Tums. Hold on, I don't know if you can see that. The ibuprofen. Okay. Trust me, it's a stressful life as a CPA. That's all I can tell you.
One would have thought you got some relief today with the extension.
No, it makes no difference to us. No, there is no relief for me. The only way out is death. How's that? Okay, that's pretty much it. There's one way out of here, and that's with a toe tag, my friend. That's all I can tell you. Where are you from, Mike? Where in Jersey are you?
I'm actually from Indianapolis.
Indianapolis. We have a lot of I have clients in every state. Turns out, this is the amazing part. I've never met in person the vast majority of all my clients, ever. Hard to believe, I know.
Well, Jack, how about that? Next time you come to Jersey, we'll have you live. Hopefully we'll have meetups.
I'm much funnier in person. That's all I can tell you.
I'm more than sure about that.
So I am. Our CPA firm is not like your traditional CPA firm. That's all I can tell you.
And Jack, feel free to post your contact information on the website for your company in the chat.
Sure. Let me just say something also. This is not a sales pitch, but one of the things we offer, and by the way, if you Google me, you'll see like 10,000 hits on me. Everybody pimps me out. That's all I can tell you. But if you want, I'd be more than happy to take a look at your prior year tax returns. We don't charge anything. It is legitimately totally free. That's all I do. And if I think your guy did a good job, I'm not embarrassed to say it. If I think he did a bad job, you have to promise not to stick your head in the oven. I can fix anything but a broken heart. I give you my word. But if you want, and you send me the returns, we have a secure link on we can email you and you can send them to us. I'll take a look at them. No problem. I mean, it's what I live for, taxes.
And guys, you can find Jack on LinkedIn or on the company website. I think the website is Your Nevada CPA, right?
Right. And we now have, it's up and running. You're a Pennsylvania CPA. We'll be having your New Jersey CPA. You're Philadelphia CPA. You're Arizona CPA. I want all the CPAs, damn it. Okay.
Excellent.
By the way, also, on our website, we have a YouTube channel, which has tons of videos on different subjects. And so it's possible you might have a question that might be covered by one of our videos. Our mission is to try and cover just about most common subjects. And so if you go to our YouTube channel, you'll see a lot of our videos. A lot of them will be on me, by the way. Should warn you ahead of time. You know, be prepared. I mean,
yeah, so guys, be prepared.
I would suggest alcohol would be involved on your part, but that's just me. You know,
I guess, Jack, a lot depends on the topic you're covering.
I can make anything interesting.
We're pretty sure. Moving on. Next question from Rick. Several years ago, PA started with transfer tax.
Oh my God.
On real estate. No, he's not your god. He's your neighbor. On real estate for the buyer too. Is this still the case?
So like one of these sales companies, not to be mentioned, told this client to set up these LLCs in Pennsylvania. And then, if you guys are familiar with the quick claiming, they told them to quick claim the property into the LLCs. Pennsylvania has a transfer tax. It would have cost this person $1 zillion to do this. And so Pennsylvania has these very old rules on transfer taxes. You can't move property into an LLC in Pennsylvania without paying a transfer tax. So what you have to do is basically buy the property in the name of the LLC to begin with. Otherwise, you're on the hook. It's just really bad. I mean, and so as far as I know, the rules are still the same. I know they're still the same. Whereas in most other states like Nevada, California, they consider that to be like not an arm's length transaction. They'll let you do it without paying any transfer taxes. So.
Does it apply to New York or New Jersey, Jack?
I don't believe so, but I'd have to check.
Okay.
Pennsylvania is just in the Stone Ages. That's all I can tell you. Well, again, it's a moneymaker for them. Listen, at the end of the day, all this is about the Benjamin Franklins. Mike, you know about Benjamin Franklins. Come on. It's what it's all about. I see him laughing.
Next question. I own a property in my name and I have rented it in Connecticut. Is it too risky to hold rental property in my name? Also, I have a mortgage on this property, so I'm not sure if I can have LLC for this property.
You can always quick claim it into an LLC, except in Pennsylvania where you have to pay transfer taxes. I mean, again, the only reason you're doing this is for liability protection. Quite frankly, if you just had one property, you know, you have to be practical about these things. I mean, everybody who has rental property, you should have a landlord's policy. Everybody should have an umbrella liability policy. Generally, that's going to be enough. By the way, I can't tell you how many times I got sued as a landlord. Some of the stories were pretty funny, too. Got sued all the time. Just happens. But if you just had the one property, I don't know that it's, I don't know you'd have to run out there and do it. I mean, and it depends. Here's a great example. If I had an Airbnb, I would be more likely to put it in an LLC than a long-term rental. Airbnbs, you have property, people going in and out all the time. I would think you would definitely increase the chances of getting sued. Just saying. But if it's a regular rental property with long-term rentals, I don't know, you'd have to do it. Raphael, I don't think you've asked a single question. This is going to be like an IRS class. I'm going to call on you. Okay. Maybe I should ask you a couple of questions. Were you paying attention, Raphael? I want to know. He says yes. Okay. Sure. Okay.
He was fun asking you about the red flags from my.
So here's a trick question. This is for, you know, a lot of time. I used to do a lot of live seminars. This was a trick question for the California people. When you call,
let me call my California people, Jack. Get them
on the phone now. That's right. When you call the California Franchise Tax Board and you ask them a question, what's the only answer you ever get? So if you ask them, what time is it? What do they tell you? If you ask them anything, $800. because that's the minimum franchise tax fee in California. They don't give a shit about nothing else. Pay me my $800, okay? That's all they want to know, okay? Talk about a bunch of bloodsuckers, okay? They're horrible. I would rather deal with the IRS every day of the week than the California Franchise Tax Board. They're brutal.
Okay. We all made up our minds. We're not going to open.
Not going to California. Don't do business in California. That's right.
Sounds good.
And the only, the second worst place I heard, Indianapolis. That's what I heard. I'm just saying, it's a room. just messing with you, Mike.
For franchise or in general?
For anything. Just kidding you.
You might be right.
Mike, time to move to Jersey.
What's the temperature like in Indianapolis today, Mike?
It's about 30 and snowing.
Yeah, it's not bad.
Aren't you tired of this?
I am.
I guarantee you, as you get older, you'll get tired of this, okay?
I am older and I am tired of it.
How many of you guys have ever been to Vegas before?
Several times.
Now, most people, again, think of Vegas as just gambling. And that's just, I mean, it's a great place to live. It really is. I mean, most people who come here just, you go to the Strip. And by the way, we like you coming here, bring plenty of money, helps keep my property taxes low. And by the way, the real estate taxes in Jersey is just insane. I look sometimes all the time about like, I'll go back and look up properties in Cherry Hill. When I lived in Woodbury, I mean, property taxes here in Nevada run about 1% of value. So my house now is probably worth about $900,000. My real estate taxes are like $5,000 a year. No state income tax at all. You can't beat this with a stick. I'm just telling you.
And on top of it, you can walk over to Jack's office and have a conversation with him.
You could. Or I like to put it differently. So if you get pissed off at me and say you're in Indianapolis and you want to come out here and kick my ass, you got to drive to the airport. You got to get on a plane. You got to get a rental car. You got to find me. By then you'll be calmed down. If you live here, you get in the car, 15 minutes later, you're kicking my ass. So I definitely have to treat the locals a little better because I'm afraid of getting an ass kicking here, okay? Just saying.
We'll keep that in mind, Jack.
Keep that in mind. That's right.
Next question.
I can tell Mike is definitely my #1 fan. He appreciates my sense of humor. Okay.
Awesome. Does revocable living trust need tax ID number and pay trust tax? You were talking about
an irrevocable trust generally will get an EI number, an employer identification number, and if it has income, it's going to have to file a tax return, but there's a way around it paying the actual trust tax by treating it as a grantor trust. So there's a Weasley way around it. And by the way, if anybody wants to set up trusts and you want to name me as the beneficiary, just make sure you spell my name correctly because Cohen is a pretty common name and I wouldn't want you to leave your inheritance to some other stranger. I'm just saying. You want to make sure it's very clear who you're leaving it to.
Jack, what about revocable trust? Irene is asking about revocable living trust.
Most times when the attorneys will set these up, a lot of times they'll get an employer identification number, but you really don't need it. I guess you would want to get one if you wanted to open up a bank account. So that would be a reason for it. But at the end of the day, for tax purposes, it ends up on your personal tax return anyway. So.
Doesn't bank use SSN as ID for trust?
If you want to open up a bank account, yes, it does. Correct.
Yeah.
Yes. So you can't open up a trust account at a bank using your social security number. It would have to have a separate employer identification number.
I think they do use social security for trust.
Well, then in that case, then you don't. Okay.
Maybe not in Nevada, but certainly in New Jersey.
I've seen it both ways where people will get an EI number and some people won't.
Yeah.
So.
That's fair. Next question. Does Connecticut have transfer tax?
I don't know. For real estate, I don't know.
Okay.
We do have clients in Connecticut, though.
So, guys,
not that many.
If there are any questions that are unanswered, feel free to email Jack. I'm sure he can get back to you through the email. Next question. What are your fees like? Do you have a fee schedule?
Somebody else put up another question. Great question, and I'll tell you about our fees. Real estate within a pension plan. The only time I think that makes sense would be if you wanted to invest in real estate and the only money you had was in your pension plan, fair enough. Other than that, I am not a big believer in pension plans owning real estate. And the reason is no capital gains. I mean, so yes, and most real estate generates losses. So losses within a pension plan do you no good. So let's just say you buy real estate, it generates losses, you don't get credit for the losses. Fast forward 20 years, you sell the property, the money goes into the pension plan. Fair enough, you didn't have to pay tax. What happens when you take the money out of the pension plan? How much tax you got to pay then? Regular income tax rates. I don't like it.
They will be in a lower tax bracket by that point.
And you know what? That's a great point, except that history has shown that to be generally not correct. You're right. If you go back to when they started with all these pension plans, the logic was you get a deduction when you put it in when you're working and you're in a high bracket, and when you take it out, you're in a low bracket. The low bracket never happened. That's the problem. You're right. That was the way it was supposed to work. I've yet to see that happen. People tend to work longer. They don't retire, or maybe by the time they retire, they've accumulated so much money. Now they're already starting to take out money from the pension plans. And so, I mean, the only benefit would be the deferral aspect, where you don't have to pay tax up front when you sell something. I just don't like it myself, but that's just my opinion. So
that's fair. What about doing business in Houston, Texas? I'm not sure what the question means.
In Houston, Texas?
Mm-hmm.
I have no idea.
It's personal income tax-free, but
well, Texas doesn't have any personal income tax.
Right.
Florida doesn't have it. Washington doesn't have it. But then again, why would you want to live in Washington? The weather sucks, okay? I'm just saying, Florida, hurricanes, right? Palmettos, humidity. Vegas is where you want to be, baby. Okay.
Jack, I think Nevada should pay you extra fees for promoting.
They should.
For sure.
I'm going to tell you something which you probably are not going to believe. I would never lie to you. Do you know I've actually convinced people to move here? I
believe you.
Absolutely 100%.
I believe you.
And if they didn't make it their primary residence, many times you know what? This is a trick question. When George McCain ran for president, they asked him how many houses he owned. He couldn't tell them, by the way. That was another story. He didn't remember. But the moral of the story is, I'm not making that part up, Mike. He couldn't remember. Turns out he had 7, I think. Okay. But he couldn't remember where they were. Okay. You can have as many homes as you want, but only one tax home. So, for example, all the movie stars in California, they have a house in California. Guess where their tax home is? Here in Nevada. Mm-hmm. So people have either actually really moved and made this their permanent residence, or they made this their tax home. I guarantee you, if you live in a high income state, let me give you a great example. Make believe you lived in New York, high taxes. Illinois, high taxes. Jersey, not that high, but high. Say over the years, you've accumulated this huge stock portfolio. You've been investing for years. And now you want to sell, right? Remember, capital gains only applies to IRS. It doesn't apply to the states. So California's personal tax rate could easily be 10%. What if before you sold your stocks, you moved? You would beat the state. Why would you want to be a New York resident and sell $10 million and have $10 million in capital gains and have to pay New York State income tax on $10 million? Where if you moved to a non-tax state and then sold the stock, you wouldn't have to pay it. It's a no-brainer. Why would you do that? There's a lot. Does that make sense?
Doesn't your tax home, though, do you have to live in that state a certain amount of time throughout the year to claim that?
Hold on 1 second, Mike. Are you done?
Yeah.
We'll come back. Yeah. So there is no bright line test to determine what your tax home is. The state, there's many factors. It could be the number of days you live in each respective state. We'll tell people to get where your driver's license is, where your voter registration is. Everybody's situation is different. For example, if you still had kids in school in your home state, it'd be kind of hard to justify moving your residence. Most people can't do it anyway, because even if you changed your home to say Nevada, but you still had a W-2 job in another state, you still got to file in the other state. So it's not like this windfall for everybody. But in certain situations, especially after Corona, most of these companies will let you work from home. They don't care where you're at. I mean, and so there could be some advantages to this. I mean, it's something to think about. And certainly, when you get to the point where you want to retire, definitely you should be thinking about it. I mean, to live in New Jersey, New Jersey has a great school system. Many of the school systems are good. But, if you're younger and still working and making a lot of money and you have your kids in school there, you can deal with it. You can accept it. Now your kids are grown and out of school. Now you're retiring and on a fixed income. Who can be paying $25,000 a year in real estate taxes? That could be your entire Social Security check. You can't afford to live there anymore. It's insane. When are you coming out here?
Tomorrow, Jack. Everyone is getting their tickets tomorrow.
That's right. We're going to charter a flight out here. That's right. And I'll give you a tour of Las Vegas. There you go.
Didn't you invite everyone for the tour? Yeah, we're all coming over.
Yeah, but it's something to think about. And when you're still working and you have kids, young kids, of course it doesn't make any difference. But I guarantee you, when you get toward retirement, it's something to think about. How are you going to afford to pay those real estate taxes? And New Jersey taxes your pensions. Pennsylvania does not, by the way, but Jersey taxes your pension. Okay, and so something to think about.
I think Nevada just acquired 23 more residents, Jack.
Well, that's okay. There's room for everybody. Rick, when you coming out here, bud?
He's there already. Look at his background. It looks like Nevada. It doesn't look anything like Jersey.
Well, that's just his background. That's right.
Okay.
All right.
I want to give a chance to these two more folks to ask their questions, and then we'll have
Sure.
But
and if you forget anything afterwards, you're welcome to either call us or email us. Not a problem.
Yeah, please, everyone, schedule your time with Jack right after that so he can get busy. It's tax season. He's not even busy. He's sitting here.
You know how many returns we're going to do this year? I'm going to take a guess.
50,000.
No, not that many. We'll probably do like 60,000. No, we'll probably do about 5,000, I think, this year. Yeah, it's a lot of tax returns. It is.
Now that you have extra time, not that you didn't have it. I mean, honestly, from a CPA perspective, what does this extension even give you? I mean, you have the extension.
It doesn't mean anything to us. It doesn't.
It's.
I'm probably working 12 hours a day, no matter what.
Honestly.
Have I ever emailed you late at night?
Every day. Do you think the IRS is giving extension to themselves instead of giving it to other people?
All I know is the IRS has two sets of rules, the rules for us and the rules for them. When they send you a notice, they want the response in 30 days and they'll never answer you back. Okay. I'm just saying, but so it's a one-way street. You get back to them on time and they'll get back to you when they can. I mean, by the way, when I become the commissioner of Internal Revenue Service, I'm going to make a lot of changes, my friend.
Now is the right time to do so?
Not happening.
Okay.
I can't take a pay cut, and I can't move to Washington. I'm sorry.
Jack, I was seriously considering moving out to Reno area, be close to Mount Rose. I was a skier.
Oh, Reno's very popular. Yeah. But we have skiing here in Las Vegas. It's called Mount Charleston. This is the craziest thing. It could be 100 degrees here and you'll see snow up on the mountains.
All right.
Mount Charleston is literally 30 minutes away. Check it
Never
out.
heard that as a destination for the last 45 years of being a skier and in a
Mount
ski club.
Charleston?
Mount Charleston, no.
Yeah. I mean, I'm not a skier myself. I mean, I don't undertake any physical activities. I thought we covered this other running to the buffet line. That was
Yeah,
it.
I heard that.
12-ounce curls. So I'm not skiing. Not happening, my friend. I don't hike. I don't ski. I don't do anything.
I did move out to Colorado for 18 months, 2 ski seasons. That's as close as I got in the Western states.
But, I have a different theory, though. When you don't do things on a regular basis, it seems more like fun. I mean, eventually, you would think you would get tired of it how much can you ski or how much can you golf before it gets even boring to you? I'm just saying. I mean, I like playing blackjack, but after a couple hours, even I get bored. Okay, I'm just saying.
Okay, Jack, let me give this last person a chance. I'll ask their question and then we'll be wrapping up, but this is definitely good stuff. What if you purchase property in New Jersey but never registered the LLC in New Jersey? What issues would you run into? Can I now register in New Jersey,
you can
sue a contractor, and also sell the property with no problem?
I mean, you can register the LLC anytime you want in New Jersey. The problem, the biggest problem I think you would have would be, number one, if you ever had to do an eviction. You're not legal. I don't think you'd get an eviction. The other problem you could have, and again, I'm not sure about this, but a lot of times the title companies will kick up a fuss when you go to sell it. I mean, I'm just saying, you're not legal in New Jersey. And I've seen title companies push back. Now, what you could do is that there's an answer to everything. Say the property was in the LLC and you wanted to sell it and the title company gave you a problem, just quick claim it back into your personal name first. That's all. And then go to closing. That's all. So there's always ways around it.
Okay, because I bought the property 2 years ago, but I never registered it in New Jersey. So now that I'm about to sell the property, I just want to make sure I don't really run into any problems.
Where's your LLC at? What state is it in?
In New York.
In New York.
Yeah.
I would say it would be easy to do, but I would just foreign file it or register it in New Jersey. It's not difficult to do. We can do that for you. I mean, or you can do it yourself, or you can go to a lawyer. It's easy to do. I mean, so, but I would do that. And yeah, why? Nothing bad has happened yet, but why tempt fate? Just do it. That's all.
Yeah, another part of that question, because earlier on in the renovation, I have a contractor that I'm looking to sue. So would that be an issue? Because
I think it would be an issue. I do. I mean, a lawyer would tell you for sure, but how can your LLC sue him in New Jersey when you're not a legal LLC?
Right.
I think you need to do that. And it's not difficult. It's not expensive at all. Take my word for it. You should just do it.
Jack, one last question before we wrap up. So if someone is working full-time in New York for a New York-based employer, can they become Nevada resident, and will they be able to avoid personal income taxes?
If you're working in New York, you can't avoid New York. That's the bottom line.
So it's double taxation? You pay taxes in both?
Well, there is no tax in Nevada. So, but yeah, if your tax home is in New York, it doesn't matter where you move to. And don't forget too, if it's a big company, they're going to want to withhold New York State income tax. So, I mean, it's never going to work. So.
Awesome. So guys, again, Jack, this was really good. Thank you so much for your feedback, for sharing the information.
Keep your cards and letters coming in.
And for inviting us over to Vegas.
And if you come to Las Vegas to visit me, I'll give you a tour of our beautiful new building. It's really something. I mean, it really is. And we have a big seminar room that we do, well, not as many as since coronavirus, but business is picking up again, and it's getting in use. And today I had to stop for a second. They're building a studio in our office, like to do our own movies and stuff.
Oh, I thought that you guys can sleep in and wouldn't go home to do the taxes day and night.
No. We're having our own in-house studio built. This is crazy.
Amazing.
Like, watch out MGM, I'm telling you, you know.
Awesome. So Jack, yournevadacpa.com, is it the best place to reach you?
Yeah, and if you want, I can give everybody our office phone number. Sure.
Go ahead.
It's 702-255-2330. And the other thing I meant, you know this already, when you become our client, we charge nothing for consulting throughout the year. It's totally free. It's the bargain of the century. That's all I can tell you. So whether it's a tax question, a strategy question, a structuring question, a real estate question, an automobile question. I used to audit automobile dealers. If you want to know whether to buy or lease a Maserati, I'll tell you. But first I have to drive it though. That's important. You get that, Mike?
I had a question.
Bad investment, by the way. You don't want to buy or lease a Maserati.
I had a question.
Sure.
What would you recommend the best places to get apartment complexes in the area you're at in Nevada?
Well, we have tons of real estate clients. I work with a number of them. I work with one in particular. And so if you want a referral for somebody to find you something, I'd be more than happy to send you this guy's information. You know, anytime you're in a strange town, I mean, listen, at the end of the day, when you're buying something, quite frankly, the commissions are being paid by the seller. So let somebody else do all the grunt work for you. You can't be running around doing this. You'll go crazy. Just use a local real estate agent. Let them find you something. That's all. I mean, by the way, real estate values here, I don't know how they are in Jersey. I don't think they're as good in Jersey. They're going crazy here. Inventory is like really low. The prices are crazy, mainly because the mortgage rates are so low. I mean, plus we got a lot of people moving here from California. I mean, they can't get out of California fast enough. Next to California would probably be Indianapolis. I think they're coming out. They're second most. And then Jersey. How's that?
Jack, can I ask you one question before you go?
Sure.
I have another call in 1 minute. I apologize, but I do have to wrap up. I have to be on the client call in 1 minute.
Call me at the office. How's that, Rick? No problem.
Okay.
Sounds good. Thank you very much, everyone.
All right. Bye.
Thank you, Jack. Thank you, Lena.
Bye.